Welcome to Taming the High Cost of College. This episode is going to be all about student loans.
You have kids, they grow up, and before you know it, it's time to plan for college.
Where do you start?
How much is it going to cost?
Will you qualify for financial aid?
Should you be looking into scholarships?
When will you be able to retire?
What about student loans?
The list of questions is never ending. The good news is, all the answers are right here. Welcome to the Taming the High Cost of College podcast. Here is your host, certified financial planner, Brad Baldridge.
Hello, welcome to Taming the High Cost of College. I'm your host, Brad Baldridge. Today is another interview with Chuck, and I haven't mentioned it recently, but Chuck is a college admissions professional. He helps families understand colleges. He works with students on essays and choosing a major and choosing a career, and he works a lot with students. So he's a great complement for me, where I tend to work with parents and talk a lot about the financial side of college. Today we're going to talk a lot about loans, but we have a bunch of previous episodes. Again, we've done a 10-episode series. This is number 8. But we've also talked about things like scholarships and need-based aid and merit aid and all kinds of different ways to pay for college, as well as choosing majors and other topics as well. I encourage you to, go back and listen to the previous episodes if you haven't. And of course, there's a couple more coming up as well. So today we're going to talk all about loans. So this episode, we talk about how to choose a loan, the pros and cons of loans. And not only do we talk about how the loans work, but we're going to talk a little bit about whether you should use loans or not. There's a lot of politics and a lot of concern around loans. Many families are worried about having their student have too much debt. Of course, on the flip side, many families are going to have to use student loans in order to make college a reality. So how do you find that balance? So that's the type of things we're going to talk about. As always, show notes are available at tamingthehighcostofcollege/127. And that's where you have access to all the links that we talk about. This week's download is the Student Loan Guide for Busy Parents. So you can go to the website and download a student loan guide, which will give you all the specifics. Again, Chuck and I talk, and obviously in audio, we don't have a lot of specifics, but you can also get some charts that will help compare, et cetera, et cetera. And we talk more about that in Brad Recommends. All right, let's go ahead and jump into the interview. All right, Chuck, welcome back.
Thanks, Brad. Glad to be here.
Today we have the exciting topic of loans. So we get to jump right in, I think.
Absolutely.
Do you get a lot of questions around loans when people are talking to you as far as how they work? Or, what comes up from your side of the fence?
Everything really comes up because there's so much media about this that students are going to automatically graduate with tons of debt. They've heard it from this news source and that news source. And so parents are just going, okay, what are the loans? What do they do? And how do I avoid having myself or my kid graduate with a mountain of debt? There's a lot of misunderstanding around this. I'm really curious as to what people, ask you as a financial person about things like how much can they borrow or, what should they even borrow, because they don't even know what these loans are.
Absolutely, yeah. And I think there's kind of two questions, and we'll cover both of them right now. But one question is, how much can I borrow? And the next question is, how much should I borrow? And those are, obviously different questions a little bit. So let's start with the how much can I borrow? You mentioned that the rumors out there of kids graduating with hundreds of thousands in debt, or even 100,000. And I would call that kind of a myth, in that a typical undergraduate student cannot borrow hundreds of thousands all by themselves. They're going to either need a cosigner or parents can borrow, but there's no way for a student all by themselves to borrow more than $27,000, again, for most families. So typical incoming freshman can borrow $5,500. After that, mom and dad need to get involved, and they can borrow more, or they could co-sign on loans to borrow more. But the most a student could borrow is $5,500. And then from there, the student can borrow more each year. So it goes up to $6,500 and then $7,500 for a couple of years, for a total of $27,000 for the whole college career for an undergrad. But I think there's a lot of students out there that go on for some form of master's. And once you become a master's student, in other words, you have an undergraduate degree, now you're considered independent, and the whole structure of financial aid changes, And a lot of graduate students can borrow large amounts of money. So the typical doctor and dentist, we all understand that they borrow a lot, but you can get similar money for an MBA or a master's in nursing or whatever degree beyond the typical undergrad. So I think that's the one big myth that people need to understand is to get into that mess, you either are already a college grad, so theoretically maybe you should know better, or there's somebody that has good credit and is co-signing, and theoretically maybe they should know better. And if not, well, again, as that gets into politics, maybe we'll skip that direction.
Yeah, I'm glad you really walked through all of that because, again, I don't know where these rumors come from and I think the news stories love to jump on these cases of families that say, my student graduated with $100,000 in debt. But as you mentioned, that is physically impossible for a student to do without someone willingly assisting them to do it. So it's not like the student can just walk up to a college and say, hey, I want to go to this very expensive school and I would like to take it all out as a loan. And the college goes, great. Yeah, no, that doesn't happen at all. There has to be someone else that helps with that process to help a student get into that much debt. And I really tell my families too, is that my goal for my family is that students graduate at or below the federal cap, which you said is $27,000 for the Stafford program. And I really think that, if you are going to take out loans, that is a solid option for students, especially because they have so many options to pay it back now. But you're the financial guy. You may have some other strategies as to how to get better loan options out there as well. So
yeah, and
what are these different types?
Yeah, and before we go to there, let this in context. So if the student borrows the full $27,000, no student has to make payments while they're in school, so they could defer it. You're going to get some interest that will accrue even though you're not paying. And then once you get all the way to the end, the student might owe $28,000 or $29,000, and a typical payment is a little over $300 a month. So it is, that's a 10-year repayment. So it is a reasonable option. Again, especially if the college degree, it does in fact lead to, better employment outcome. The challenge, I think, for a lot of students are the students that don't make it. So they drop out and they still have the student loan debt that they have to repay, but they don't have the degree. Or again, and sometimes it's students that borrow money to get into a degree that's ultimately not a good fit for their career, or they don't use their degree, or whatever it might be, and they find themselves underemployed. All right, so let's talk about how much I should borrow. I get parents often with that conundrum of, all right, well, it makes sense for the student to borrow that first $27,000, but that's not going to get us there. We're thinking about borrowing even more than that. Now, should we do it? Should we borrow another 10, 20, 50, 100, whatever that number might be? And I don't know what your thoughts on that are, but again, if it's the only way to get it done, I think that's a different question than I want to borrow all this extra money because there's a particular school that's really expensive and that's the one I want to pick. I've got lower cost options, but my dream school happens to be very expensive. Do you see families struggling with that?
Yeah, a lot. I have a lot of families that are saying that they want to figure out, so there's that one scenario. It's like they want to go to the dream school, which is very expensive, and they're trying to figure out how to make that work financially. And I always tell families our goal is to find a fit academically, socially, and financially. And sometimes we may have to say no to a college if the financial thing is going to be way out of whack. So I always warn families, that's taking on a lot of debt. Anything beyond the 27, in my opinion, is taking on a lot of debt. So I always think about what are alternative ways of also making this work. So encouraging students to have an on-campus job or doing summer employment or other ways that can help bring in some money to make it more affordable. But once you go beyond that 27,000 for the Stafford, I think parents are very confused as to where to look and what is a good loan beyond that, what is a bad loan, or who should I talk to, who should I not talk to. And that's literally where I go, you have hit a point where I have no idea how to help you. I am sending you to Brad.
Yes. Yeah, exactly. And then typically we'll go through kind of the loan options. So there are essentially 3 ways that you can borrow for college. One is the federal programs, which would be the direct loan also called the Stafford loan, sometimes federal direct student loan, subsidized direct student loan, unsubsidized direct student loan. It's all the same program. And then there's the PLUS loan, which is a loan to the parents. Now, the limits we've talked about, the $27,000, that applies to the direct loan, and that's what the student can borrow. Now, the PLUS loan is a loan to the parents, and the parents can literally borrow the entire cost of attendance. So if your student, were accepted at University of Chicago, which costs $80,000, theoretically, a parent could sign for $80,000 per year in PLUS loans. And what's really interesting about the PLUS loan is they don't ask how you're going to pay it back, like a typical mortgage company or other loan where they would look at your income, your assets, and your likelihood of paying it back before you give the money. The federal PLUS loan program, they verify that you're not, in the middle of bankruptcy or have a recent bankruptcy or have something very wrong with your credit. But if you pass that basic credit check of, they don't really look at your income and you can borrow large amounts of money. Again, it's the parent borrowing the money though. So the parent can always fill the gap because they could borrow again that $80,000 per year for 4 years to go to one of the most expensive schools, even if you got no aid whatsoever.
That's a little frightening to me that the Parent Plus loan just kind of throws money out as long as you pass that kind of very minimal test. And, that's probably, I'm going to guess, where we're hearing some of these news stories of they say, oh, my quote unquote, my student had to borrow $100,000 to go to college, where that's probably not the truth. It's probably the parents have utilized the Parent Plus loan and then have borrowed up to the cost of college. And, U Chicago, that's going to be $320,000 for 4 years. Oh, my word, that's a lot of debt. Wow.
Right, exactly. And there's just a news story, and they come out about every couple of months. There's a news story, and this particular situation was a 60-year-old or 65-year-old about to retire family, a husband and wife, and they had 3 or 4 kids, and they borrowed quite a bit in order to pay for college, and then they went through some unemployment and other challenges. So they didn't, they borrowed, I don't remember the exact numbers, but it's like they borrowed $250,000 and then deferred it and weren't able to pay for many years, and now they're owing a little over $400,000. And they're looking to retire, and they've got these huge debts, and they're just struggling. And of course, that's the downside of borrowing too much money in the PLUS loan is, and it's very hard to discharge in bankruptcy as an example too. So it is a safety valve where parents can fill the gap, but the question of whether the parents should fill the gap is kind of a different question. And I think it really boils down to, do we have lower cost options, or is this just, again, to get the dream school? I kind of look at it like similar to a car purchase, right? I can afford a Chevy, but I really want a Mercedes. Well, then you need to have enough assets and income and the ability to pay for a Mercedes and still be able to do everything else you want to do. Well, I don't. Well, then maybe you can't have a Mercedes. That's, and again, that's kind of the way it works everywhere else except for college and healthcare, where, again, they've got these weird incentives around loans and different ways that things get paid. All right, so that's the federal programs.
Right. What are some options beyond federal? Because I'm familiar enough with the federal programs that I can give parents that direction. Okay, here's the Stafford program, which is fairly straightforward. Here's the Parent Plus program, which is a higher interest rate, but it is also, as you said, fairly straightforward and not a whole lot of bumps. What are other options that parents should be considering to think about loans?
Right. Well, next we have the private student loans. So there's the old guard, Wells Fargo, Discover student loans. A number of big banks offer student loans. Sallie Mae is another big name out there. And they've been providing student loans for years, but they're not the federal program. They are an arrangement, between typically a parent and maybe a student as well and the institution. But it does get the label student loan, so it does qualify for things like the tax breaks. And it also means it's very hard to discharge in bankruptcy again. That's been kind of the trade-off for student loans is, if we're going to give student loans to families that perhaps can't afford to pay it back, well, then we can't allow them to discharge it in bankruptcy and still give good interest rates. So that's kind of been the compromise. So private loans are also like that, where you can't discharge them because they've got the student loan label, so to speak. And then the private loans are kind of like negotiating for a credit card or a boat loan or a mortgage, where the interest rate could be very, very good for very strong candidates and very, very bad for poorer candidates. I mean, I've seen private student loans come in at 10, 11, 12%. And, it falls almost in the predatory lending area. Not quite that bad, but again, you need to understand. And then they also offer sometimes variable rates where they were good for a while, but then rates went up. So some of those problems. The one advantage to a private loan is you could make the student the primary borrower and the parents can just co-sign. In the end, they underwrite it based on the parents' information because they know the student has no credit, has no income, has no history. So they look at the parent, and again, the parent's going to have to step in if the student should not pay. And that's, so that's really the only person they can look at to figure out what the interest rate should be and that type of thing. But again, if you're saying I absolutely want to borrow more money and I absolutely need it in my student's name, well, the private loan is a way to do that. Again, the plus loan, where the interest rate is reasonable, has to be in the parent's name. So the private loan allows you to put additional loans in a student's name. And I see that occasionally where parents say, well, this is how much we were allowed to borrow, or this is how much we're willing to put towards college. You're going to have to borrow the rest. They use the student loan, direct loan, and then some additional privates perhaps to get all the money that they need in order to make school work, knowing that the private loan might have a higher interest rate. But again, from a parent perspective, it's a higher interest rate, but the student's paying it. So in the end, it saves them money because they're not responsible theoretically. And then often we'll have a discussion and parents will say something, well, why would I borrow money at 8% or 6% or whatever the interest rates are when I can go get a home equity line of credit for 3%? And my typical answer to that is, well, maybe you wouldn't. Maybe that 3% is the best way for you to borrow. It doesn't work for everyone, of course, because you need to have a home and you need to have equity. And if you don't have both of those things, and also a decent credit rating. So if you have all three of those things, yeah, that might be the lowest cost money, and it may make sense for your family to use that method where, and again, it could be a home equity line of credit, or it could be a complete first mortgage refinance and you pull some cash out. There's different strategies around that. But again, debt is debt. Ultimately, if you borrow $20,000, your net worth goes down by $20,000, whether you borrow it against the house, you use a student loan, the student signs and you co-sign. No matter how you slice it, there's $20,000 negative on your net worth now. The question becomes, well, if I default, they could take my house if I used my house to back it. If it's a student loan, there's not much they can do, but we can't discharge it in bankruptcy. So there's different, pros and cons around how the loans work. And I think you need to understand and read the fine print of all the choices that are out there.
Yeah, and that's why I said when we start crossing some of these questions in my family conversations, I tell them, you know what, these are awesome questions, and Brad can answer them for you. So I have one for you that I get often. So I'm thinking of a family who did really well at the young part of their life, their early marriage. They had a business and they had a bunch of money and they stuck it into a retirement account. And then later kids came along getting ready for college, but they had this big nest egg for retirement. And I've had families ask, so can we take out money from our retirement in order to pay for college? Because the family believes they'll be able to hopefully earn it back over the years that the kid is in college. So they're wondering, can they use retirement funds to help pay for college?
Yeah, that's a great question. And generally my answer is no. And sometimes from a technical perspective, it's hard to do. But also from a should you do it perspective, the answer could be no. Again, unless you're doing some relatively advanced planning. So if the family you just talked about, if we sat down and said, okay, well, we're well on track for retirement. A matter of fact, we do have quite a bit of extra money in the retirement. Then we could potentially, take a loan against it for a few years to fill the gaps for college. Or another common strategy is you just slow down your contributions to retirement. I've always put in 15% from the time I've, been very young and started working. But now that I've got college on the horizon, I'm going to drop that to 5% because that's what the company matches. And now I have 10% more cash flow coming in. and I can use that to pay for college or refinance the house. Or again, now we're looking at overall broad financial planning of how do we, pay for college. And then typically for most families, how do we pay for college? Then we've got a little bit of a runway, and then we're going to retire. And for some families that, we've got college is done and we've got 5 years to prep for retirement. Other families I work with, it's like, well, we're actually going to be retiring while our youngest is still in college. And, so there's a lot of moving parts there. But the reality of it is, if you do good financial planning overall, it allows you to, get more retirement and more college from the same, bucket of assets and income.
Right.
Just being as efficient as you can be. And that's, I think, what it takes for a lot of families is just, you got to be efficient so that you can get it all squeezed in, so to speak.
I guess, and yeah, I think that's very helpful to help families think about their overall, what's going on with their investments and their retirement and their plan that way. Because, yeah, as you said, sometimes it might be just reducing a payment that helps you then have more money that's available for college. That's a good idea. Another scenario is that parents will say, I really want my student to be responsible for college financially. They often say, well, I paid for my way for college, many years ago. So I want my student to be responsible for it. But then they also say to me, but the interest rates for student type programs are much higher than what I can get from my bank, because maybe I've been doing a lot of banking in my life and I've done a lot of investing. And so they tell me, but the bank will give me a loan and not my kid a loan. So how do you help a family that's struggling between, they want their kid to pay for it, but those interest rates might be higher, whereas a parent could take out a loan, but the interest rates might be lower, but then it's not the student's name?
Yes. Well, and again, I think that those are competing goals where, again, we want to finance college at the lowest cost. Often that is the home equity or the Parent Plus loan, or if the parents have really strong credit, they might go to that private market and get, a 3 or 4 or 5%, a relatively good loan. But again, it's always on the parents to get the good loan because they have the strong credit and the income that, verifiable income and everything else. So in a lot of cases, you really can't do it other than perhaps you could be the bank. In other words, the parent borrows the money at the low cost option, whatever that is, and turns around and says, all right, little Johnny or Susie or whoever it is that they're working with, we borrowed this money in our own name, but we expect you to pay us back when you can. The challenge there, again, is a lot of students don't really know, what borrowing another $20,000 on top of the $27,000 they've already borrowed means as far as payments and that kind of stuff. So I often recommend, if you're going to go down that road, think about doing something in writing and make sure you talk about it often. So it's not like, well, we talked about it when they were a freshman and now they've graduated and the working rule 3 years and they're not paying mom and dad back and you're trying to collect and they're like, I don't remember saying any of that kind of stuff. So it's one of those things where you might have an annual meeting about it, but make some rules. And again, if I were trying to enforce my student paying me back, I would make rules like, well, you can't buy a new car until you've paid me back. You can, and we can talk about you buying a used car or a reasonable version of a car because you're going to need it to run your life. But if someone's going to buy a new car, I'm not sacrificing new cars to get you through college and then have you go out and buy a new car, and where I've never had a new car kind of issue. And maybe you can't live without a roommate until all the money's paid back. And again, roommate might be, well, if you get married, now you've got a roommate. So, again, you can make it as, as strict as you want to be, but you got to put those ideas in the head ahead of time that the student is sacrificing and they have to know about it and they need to hear about it quite a bit, because otherwise a typical graduate, right? They need new furniture. They need a new car. They need a nice apartment. Right. They need. And all of a sudden they've figured out how to spend every penny they make. And it's just mom and dad. So do I really need to pay him back? Maybe I'll pay him back. I'll start paying him next year, or maybe the year after that, or maybe they'll forget about it and then I won't have to pay them. And that's, again, very typical, a typical 12 to 15-year-old. Hey, mom, could I borrow $20? I want to go to the movies or something. Well, they're not borrowing $20. They just want $20. They have no intention of paying it back, but borrow sounds better than, hey, give me 20. So I think that's the reality, that it is a challenge, and, college has gotten a lot more expensive where it's, occasionally, and I don't know if you've heard this, but I've had some parents say, well, I worked my way through college. We're not paying.
Yeah, all the time. That is probably the most common phrase parents will tell me when we're talking about financing college.
Right. And I worked my way through college, but when I earned, $3,000 or $4,000 in a summer, and the whole cost of college for the year was $7,000, and I was able to borrow some money, et cetera, it actually was relatively easy to make it work out. It just doesn't work that way anymore when, a typical college might be, typical low-cost college might be $20,000. It's really hard for a typical student, to work through high school, work through college, and come up with, $80,000 in order to cover, the typical college now. So it is great that you worked your way through school, but it is not a realistic ask, I think, for most young people.
Well, and I think there's also, we're seeing some lifestyle choices that have switched between generations as well. We saw more people, years ago living at home and going to college. Well, that saves money as well. And I'm not seeing as much of that with this generation. Or, summer jobs still, you said you earned about $3,000 to $5,000 over the summer when you were in college. That's about what my students earn now too. So that hasn't gone up. So if students can earn $20,000 over the summer, finding some amazing job, then the conversation might shift. But it's really hard for families to think about what is the actual out-of-pocket costs and how much that has increased, and just the cost of living has increased for multiple things, whether that's rent or having a cell phone or things that we just didn't have 20 years ago.
Right, absolutely. So I think, so again, the game has changed and the rules have changed. So kind of sticking with the old idea that a kid can take care of themselves is a bit of a challenge. And the reality of it is you perhaps can do it once you're 25 or older, because now you're independent. And now the fact that mom and dad have income and assets doesn't blow you out of the water for some of the types of aid that you may not get when you have to report parents. So that's the challenge too, is because mom and dad look like they can afford to help, typically colleges are going to ask mom and dad to help. And if they say no, colleges aren't going to just say, oh, well, in that case, we'll put more money out there. They don't do that. So that's, again, part of the puzzle.
Yep, absolutely. So what about these families that, they really want the kid really wants to go to a very, very expensive school, but the parents don't want to bury their kid in that debt, even if it is the $27,000 Stafford loan. But, there's really no other option. So the parents don't have another way to get an alternative loan or to get something else. So the student's going to have to take out a bunch of loans. Like, what do you do? What do you tell to families that say, oh my gosh, my student's going to have to take out a bunch of debt in order to make this happen, but I don't want them to take out debt to make this happen? Like, how do you help that family?
Well, yeah, another common catch-22 of, again, we're going to have to borrow to make college happen. I mean, there's, I guess, two different scenarios here. One is we're going to have to borrow to make college happen at all. In that situation, especially for kids that are going to earn degrees that quote unquote pay well, right? If you're going to go off and get your accounting degree and then CPA or a nursing degree, even a teaching degree or engineering, there are lots of degrees that lead directly to a decent paying job. And if you're, if that's the path and you look at the, again, that degree and you say, well, I could live at home once I graduate and work for a year or two, or I could, again, live like the poor college student after I graduate, I should have some extra money that will help me, pay down these loans.
Right.
And I think that's one important thing to think about. It may make sense to get the degree. Again, a typical nurse starts at 50 or 60,000, which is, 25 plus per hour. Does it make sense to work your minimum wage job and struggle for 8 years going part-time to ultimately get your nursing degree? Or does it make more sense to just borrow the money, get the degree done, go earn the good money, and pay the loans back?
Yeah.
I should say any student that's going to be obviously successful, you're pretty sure that they've got the skills to get through college and get it done in 4 or 5. I think that just makes sense, is just go get it done. And yes, now the student's got quite a lot of debt to deal with. And again, nursing, I always talk about, well, they could work some swing shifts on a Saturday potentially, or do something extra. And if if it's overtime on the Saturday and at $40 an hour, that's much better use of your time, I think, than, again, working minimum wage at the care facility when all you have is a CNA or something, and, you're making, $12 an hour or even minimum wage. And it's just a struggle for year after year after year to make it all fit.
Right. And, the federal government really views going to college as a quote unquote job. So if you're doing your studies and spending all those hours, you're spending 20 to 30 hours, whether it's in class or doing homework and stuff, and now you're trying to balance a job on top of that, for some students, that is a rough balance, and that is going to cause, stress, a mental health challenge, things like that. So I agree with you that for some students, the best scenario might be to just take on the debt and get through the degree and then go back to living and having a job and, only having one thing or the other. So you either have college or you have work, not both simultaneously.
And again, there's been studies out there that, up to 8 or 10 hours a week of work for a typical college student has no impact on grades.
Right.
It probably has an impact on their social life slightly, or their time wasting. How quickly do you get through the shower and get going? If you've got 3 hours of work today, you get up, get going instead of sleeping until 10. Some of those things. But I think there is a very much a difference around that. The other scenario, yeah, where, okay, I'd really like to go to this school, and this school is, $20,000 a year more than 3 other really good options, but again, this one's my dream school.
Mm-hmm.
Now that, to borrow money to do that and have the student do it, again, I think you really, if the parents are saying, well, if you think you want to do it, we'll facilitate it, we'll co-sign or whatever it is. Obviously, the parents are taking some risk. That's another great example of where I would kind of require that, we have a yearly meeting to talk about, hey, I'm on the hook with you. So because of that, these are some of the rules that we're going to put in place. Now, if a parent says, and again, we were talking earlier, I think sometimes parents also want to, pick a typical school, a more expensive school. Sometimes they're buying a name, they get to show up at the water cooler at work and say, my kid's going to X, and X is prestigious or more prestigious than average. And if that's the case, it's probably not worth it in the long run.
Yeah, well, even the one where you said that the student would have to take on the extra debt to go to the prestigious school, I go back to the concern that does a 17 or 18-year-old understand how that is going to play out over the course of their life? I think there's a lot of weight put on the name of the college for families when they're making these decisions. And there aren't a ton of colleges that, if you just go there, I can't even think of any, that if you go to XYZ college, you're going to automatically have a successful life for the rest of your life. I've seen students go to very, very prestigious institutions and still end up working a, hourly position because they just didn't know how to network. They didn't know how to, apply themselves, stuff like that. Just going to a prestigious school does not guarantee that your life is going to be perfect. And sometimes I'll bring up also the scenario of why don't you go to a cheaper option for undergrad and then go to prestigious XYZ school for graduate school, because in America, most people pay attention to where your most recent degree is from, not where you started at college. So there's some very great examples of some famous people out there that no one understands that they started off at a community college, eventually transferred to a four-year public, and then went to big name prestigious school for their graduate degree or their MBA. So that's the other factor that we have to think about here. Is that important? In some parts of the country, it is, and families are willing to put themselves into a huge debt load to be able to accomplish that. But for many, many students and families, the cheaper option is actually going to do just as well as the prestigious, more expensive option.
Right. Again, and there's also families who truly can afford. I mean, I had a family, and Dad essentially said the budget per student is $125,000 from me. Anything beyond that, then the student is going to have to figure out. And he was willing to co-sign and do other things potentially in the right situation. But, we were able to work it out where, one student actually came in under that line, and then the other student had to borrow a little bit on the direct loan. I think it was like $12,000. So in order to fill the final gaps as far as beyond what Dad was willing to spend. And, Dad had a decent income and Dad valued education. So Dad gave up something else in order to have that kind of money for college. So he didn't have the lake home, or he didn't buy the expensive cars, and again, because there's always one more thing you can add to the family budget that makes college less and less affordable. And, and again, we see that a lot where the whole idea that if I earn X, then college should be affordable. Well, that X is a really big number, because a typical family, earning $150,000 and earning $70,000 and earning $250,000, they all struggle with college. It's a different type of struggle potentially where, again, at the lower incomes, maybe you're struggling how to make even the lowest cost state school work. And then as you climb the income ladder, now you're making decisions around, well, should we spend more for a private school? Not that private schools are always going to be more expensive, sometimes they're less, but should we spend more on the dream school, whatever that means? Or,
right.
And again, there's no right or wrong answer, but again, if you're going to use large amounts of debt to make it happen, I think that should give you pause.
Yeah, and if you're looking for more affordable options in college, someone like me can help you find different options or different pathways to get to that option that are significantly more affordable.
Absolutely. I think that's where planning comes in, where working with Chuck to find the lower cost options and working with myself to lay out an efficient plan, again, you can potentially really kind of work it out to where there's a lot more opportunity. And again, it's also a lot more work where ultimately you're going to have to understand how pricing works at different types of schools. And you're going to have to understand, how transfer strategies work and understand scholarships and all the different avenues, which is a little more legwork, but again, it's well worth it. And we can avoid loans essentially by using some of our time, whether it's, whether it's working with a professional or, taking a course or reading some books or just jumping in and working with the colleges themselves. There's lots of ways to do it, but it's going to take some effort. All right. I think that covers what we need to cover on loans. We are going to come back next week and talk about college testing. So we're going to talk about the ACT, SAT, and we'll talk to you then. All right, that was a great interview with Chuck. Again, if you're interested in contacting Chuck, you can get information here on our website at tamingthehighcostofcollege.com/127. And you can get contact information, both myself and for Chuck. Don't go away. We're going to talk a little bit more about the student loan guide for busy parents.
The latest tips, tricks, and tools you can use today. This is Brad Recommends on Taming the High Cost of College.
Today I'm recommending my student loan guide for busy parents. Now, the student loan guide is a document that I put together. It's a PDF that you can download just by going to tamingthehighcostofcollege/127. That's where the show notes are, and you can then grab the download. But this student loan guide is written for parents, and it has all the very specifics on the loans that parents might consider. So I took all the information on the direct loan, the plus loan, and private loans and kind of compiled it. There's a chart in there that gives you a quick reference where you can kind of quickly compare some of the options. And then in addition, we've got some of the facts and figures and how the interest rates are calculated. So it has everything you're ever going to need to know about student loans. And there's two ways you can use this. The first is early in the process. So as you're starting to think about college and maybe you got freshman, sophomore, junior, you need to understand at least the basics of how loans work so that you don't make assumptions about loans and then discover later on that maybe you can't have the loan you thought you could. And I see that quite often where families are saying, well, show me the loans that will do this. And unfortunately, I have to tell them those types of loans don't exist. So the first part is really understanding the direct loan and the plus loan and private loans so that you can pick the ones that are right for you and bake them into your plan as you're visiting colleges and that type of thing. And then later in the process, when it's finally time to raise the funds and come up with the money, you can use the student loan guide again to refamiliarize yourself with all the different loans and then learn some of the basics on the process. Now, the goal of the student loan guide is not to be this exhaustive, long book that families need to read, but I'm trying to keep it concise and to the point so that you can get through it in 20 minutes or half an hour and not have to spend hours and hours trying to figure out how loans are going to work for your situation. So again, it's kind of a combination of some cheat sheets and some quick summaries so that families, like I said, can cut to the chase and really understand loans. And I recommend all families at least understand the basics of loans so that you can decide if loans are going to be right for your situation. And again, for many families, loans are just going to be part of the reality where you're going to need to use some loans to make it happen. And for other families, you might be taking loans to upgrade and get to that more expensive school that you feel is worth it. All right, that's all we have on the student loan guide. I appreciate you guys coming out and listening. As always, show notes available at tamingthehighcostofcollege/127. And then in addition to that, please leave us a review where you can. If you're listening through Apple or Google, there's always reviews available there. All right, that's all we have, and we'll see you next week.
Thank you for listening to the Taming the High Cost of College podcast. Now it's time for you to take action. Head to tamingthehighcostofcollege.com for show notes, bonus content, and to leave feedback for Brad. The next step on your college journey starts now.
Brad Baldridge is a registered representative of Cambridge Investment Research and an investment advisor representative of Cambridge Investment Research Advisors, a registered investment advisor. Securities are offered through Cambridge Investment Research Incorporated, a broker-dealer and member of FINRA and SIPC. Brad owns two companies, Baldridge Wealth Management and Baldridge College Solutions. The Baldridge companies are not affiliated with Cambridge Investment Research.